Okay, we have holding period returns, geometric returns, and arithmetic returns. Let's look at them historically. So if we look at holding period returns, there was a famous set of studies from Ibbotson that talked about stocks, bonds, and treasury notes, treasury bills, and treasury government bonds from 1926 to, I think it went up to 2009, so probably about 85 years worth of data. And that data showed that our chart here, small company stocks outperformed large company stocks, and long-term government bonds and treasury bills and inflation. Small company stocks did the best. And so the more volatility in an equity issue or a stock, the more volatility, more than likely the better return. Now, however, that's on average. So certain small company stocks are going to do well. A lot of them are not going to do well. But the ones that do well become large company stocks. So it kind of makes sense that small company stocks would give you a better return on average because there's so much more room to grow than large company stocks. Large company stocks, say take Exxon for example. Exxon's a huge oil conglomerate. And you start thinking about how much faster they can grow. Well, it's very difficult for them to grow. But you start a new company that has got plenty of room to grow. I remember when Home Depot started, they had one store. One Home Depot store. How much growth can you have? Lots. 2 stores, you doubled your growth. So you've got tons of room to grow in that. Walmart started Sam Walton started with 1 store. And so how much room do you have to grow? Lots. So small company stocks have room to grow, which makes sense why they outperform large company stocks. On the other hand, when you start thinking about it, small company stocks have got to go up against the large company firms. So there's a lot of failure in small company stocks too. So there's a lot of volatility. They could succeed, they could fail. The ones that do succeed add to the averages. The ones that fail, of course, lose out. So when you look at the historical holding period returns, small cap stocks, or the ones that are more volatile, outperform the ones that are less volatile. And volatility in financial terms is risk. We use risk and volatility somewhat interchangeably. The ups and downs of investing life. Investments don't offer their returns on a consistent basis. Years are higher, years are lower. We know this, no big deal. Obviously, some years you're going to have losses. Historically, the most rewarding investments have the most volatile returns. The least rewarding investments have the least volatile returns. And when you look at that historically, there's a series of charts here that you can look at. Small company stocks, you can see that the returns are quite large. Well, obviously the 1929 crash is going to be really bad returns. You can see lots of years in the 50s there, 50% losses. But besides that, they've got quite a few years they've got 50% gains in the small cap index where they've done really well, and a couple of years of huge losses over time. And so the small company stocks give you pretty good returns, except when they start losing. If you look at treasury bills over there to the next side of the slide, you can see that the top, which is long-term government bonds, have soared in the 1980s. If you were around in the 1980s, you remember high interest rates, and that's when long-term government bonds soared. And then the treasury bills underneath it follow that trend, but you can see they were rising over time and hit a peak in the 80s and have been going down so far. They've been going down steadily since then until today. So you can see what the differences are in your returns over time and how many years you have of volatility, how many years you have of it being a positive return and negative return. Another way to look at this is a frequency distribution. The frequency distribution shows you how many years each return has been. So in the top, we're looking at large company stocks, and if you look at the word percent in the middle at the middle of the slide, it says percent. So from 0 to 10%, that's how many years returned 0 to 10%. The next 10 to 20, you can see what years return 10 to 20%. You can see it's clearly leaning towards a positive return, that more years have had a positive return than a negative return. If you look to the left of the percent word, 0 to negative 10%, there's been quite a few years where we've had up to a 10% return. that's been negative. And then you've got 5 years that are 10 to 20%, 3 years that are 20 to 30%, and a couple of years that are really bad. 1937 is 30 to 40%. 2008, of course, was a bad year. And then 1931 was 40 to 50% off, which is obviously not a good year at all. If you look past that to the small company stocks, you can see that they have just a little bit more volatility, a few more in the negative column. The 1930 1 year that is both large company and small company stocks were 40 to 50%. Small company stocks in 1929 and 1937 were down 50 to 60%. Of course, that's the depression that we're talking about. But 2008's in there. 2008 was a really bad year. 2008 for both large and small company stocks was negative 30 to 40%. On the other hand, if you look at the bounce back, if you look at small company stocks, 140 to 150% was 1933. So 1932, 31 they crashed, and then they came roaring back in 1933 to 140% on average for that year, which was a pretty amazing bounce back for the time. So when you start looking at volatility, you want to start thinking about volatility. The bounciness of the stock and how much it goes up and down is a proxy for risk. And so the higher the risk you take, the more volatility you take, then the more returns you potentially could get. Of course, obviously depends on the company, individual company, but that's the lesson that history has shown us. If you go past that, the historical returns, you can see the distribution. The distribution of average return and standard deviation is shown here. Small company stocks, average return from 1926 to 2009 is 16.6%. Standard deviation is 32.8%. And we'll talk more about standard deviations in a little statistics refresher in a minute, but 16.8% return is pretty good over that time period, and a standard deviation of 32.8% is wide volatility. And you can see the difference here. Large company stocks, less return, less standard deviation, less volatility. Long-term corporate bonds, lower return, lower volatility, and so on. So you can see that it holds across time, that the more volatile an issue is, the lower the return it is. And so that's a very important caveat, is if you want to take a lot of risk, or if you want to take a lot of return, you're going to have to deal with the volatility of the investment going up and down quite a bit. Beyond that, there's the Callan periodic table of investment returns. Now, this isn't in your textbook. I pulled this out because I happen to like this as a view of different segments of the market. Now, each color here represents a different segment. For example, the rust or orangey red color here is the S&P 500 growth stocks, and the black is the Russell 2000 small cap stocks, and so on. So you can see that these are over years. So the far right-hand corner is the 2015 year, far left-hand side is the 1996 year, and each year they've ranked them in their returns. So in the upper left-hand corner, you can see that the S&P 500 growth returned about 23%, and in 2015 it returned about 5%, both of which were the high water marks for that year, and then they put them in order underneath it. The reason I brought this up is because I think you can easily see that it's very difficult to decide which classification of investment will do well next year. There doesn't seem to be any pattern here that you could look at and say, okay, it did well this year, next year it should do well, or next year it shouldn't do well. It's kind of sporadic all over the place. How would you predict what's going to happen next year based on the previous year? Well, it's very difficult. You can see if you just take your eyes, because the colors are easy to see, that the Rust S&P 500 growth was at the top, then it was at the bottom, then it was kind of mixed in the middle, and now it's back up at the top. Well, how would you predict it based on past returns? To be very, very difficult, right? The gold color that is at the bottom at the beginning on the far left-hand side, the gold-colored squares are emerging markets. And emerging markets didn't do well in the middle 90s. Then all of a sudden, 2003 to 2007, they were leading the market and at the top. So that gold squares there, you can see that they're were up at the top, and now they're back down at the bottom. But they're not at the bottom every year. You can see in 2011 they're at the bottom, in 2012 they're at the top, in 2013 they're back at the bottom, and they stayed at the bottom 2014, 2015. So the idea of being able to pick the next year's returns based on last year's returns, very difficult to do, and it's really easy to see when you put a color-coded chart like this. If you want more, you can go to Callan and Associates and find more. I think if you type in your email address, I'm not recommending them. I do think they have a really cool chart, which is why I'm showing it to you. So interpretation of the frequency distributions, here's a couple of things we can think about. One is small company stocks have a higher average return and a wider array or variance or standard deviation of actual returns. Large company stocks have a lower return than small company stocks and a narrower array than small company stocks in their actual returns, but more than bonds or government, either corporate bonds or government bonds. And so the conclusion is, in any given observation period, it is more likely that large company stocks will produce a return near the mean than small company stocks. In other words, their distributions are narrower, so they have less variance. Also, on average, small company stocks produce a greater return than large company stocks, but there's also a much greater likelihood of a loss in any given year. So if you have the stomach to wade through small company stocks, you can, or you can look at large company stocks as a more narrower, safer distribution, and both of which return far greater than the rate of inflation and over time, and that's much better than long-term bonds or corporate bonds, long-term government bonds or corporate bonds. So we look at stocks as being the go-to investment for people who want to invest in the markets as a sort of a default on where you want to put your money. And when we say stocks, really remember we're valuing companies. We're investing in companies. We're not just investing in pieces of paper. So that's a good historical review of the periods of return. And let's keep going. We've got another section coming.